WTI crude oil is now trading at near $68 a barrel, which is down about 13% from just over a week ago. What's causing this sell-off? Will it continue? What is the oil price signaling when it comes to the elections? Is it predicting a winner? And what geopolitical events may drive the oil price in the future? We'll be talking about all these themes and why OPEC may come to an end in the foreseeable future with our next guest, Doomberg. He is the head writer at the collective known as Doomberg, a very popular Substack covering energy, geopolitics, and commodities. Link down below if you'd like to follow Doomberg, and link down below if you'd like to watch our previous interview with Doomberg from just a few months ago. Welcome back to the show.
David Lynn, the best dressed man in finance. How are you, my friend?
I try. It's very hard to keep up with the green chicken avatar, but I hope the suit will suffice. People can check out our last interview with Doomberg, by the way, link down below. He was joined by Paul Sankey, another oil analyst. That was a great hit. We're going to give an update now. Let's talk about what's been going on with the energy markets first, Doomberg. Like I mentioned in the introduction, WTI erased most of 2024's gains. It's now trading about $70. Some cite weakness in China. Others cite a de-escalation in geopolitical risks as the factor. What's your take? What's been going on? And then we'll talk about what's next.
So all of the things you referenced are certainly contributing, but we have a slightly different take, which we have been writing about since December when we first wrote a piece that was controversial at the time called Peak Cheap Oil is a Myth. What we're actually seeing in the oil markets, we believe, is the forces of arbitrage grinding away at the price differential between natural gas and oil. And in particular, China has sort of surprised in the speed with which it is switching from diesel-powered trucks to trucks powered by LNG. And I saw a report in Bloomberg recently that said 30% of the new trucks sold in, delivery trucks, long-haul trucks sold in China in April were powered by natural gas, which is a staggering number. And Goldman estimated that the net impact to diesel demand was something on the order of 800,000 to 1 million barrels a day. The closest 10 million diesel demand globally is 30 million barrels a day. And so that's a 3% switch away from oil products towards natural gas. And I do think this is the overhang in the market that many analysts are missing. In the end, things that do the same thing sell for the same price. And if natural gas is going to be relatively cheap, engines will be switched because heat is heat. And I also do think that some people are misinterpreting the demand for diesel in China as a sign of economic weakness. We think it's actually a sign of ongoing switching to close the arbitrage that exists on an energy content basis between the price of natural gas and the price of diesel in this case.
Well, do you think that going into the winter months, things will pick up for energy demand?
We don't see much on the radar that is bullish for oil. Now, if you think we're a good contraindicator, I suppose that's a statement.
But I didn't say that.
No. I mean, there is always, people who like to think that sentiment is the main driver of the markets, and that's actually a fair way to trade the markets. Others measure that quite well. From our view, oil is actually down to 67 as we're recording this here on Friday, and essentially all of the geopolitical premium in oil has now been squeezed out of the market, which is something I know we'll talk about later. If you scan the world right now, oil is oversupplied despite OPEC holding back excess capacity. I see this week that OPEC yet again declined to increase their output, which is an interesting sign considering how much slack they have in the system. Natural gas is well oversupplied in the US and looks set to continue, as I just saw a headline that 3 LNG export facility permits have been overturned by a court in DC on environmental justice grounds, which has the effect of trapping natural gas in the US and crushing its price. Worldwide, LNG prices are basically trading on an energy parity basis with Brent, which means there's no longer a geopolitical risk premium embedded in oil, at least. Coal is relatively managed, which means basically, as we always say, the most important question that an economist should ask is the world long or short energy? Right now, it seems like we're relatively long. And so unless and until we see a geopolitical spark or the economy begins to sort of grow at a more accelerated rate than it is today, I think the headwinds will be the dominant narrative for physical energy markets in the next, say, 3 to 6 months.
Before we continue with the interview, I'm going to tell you about another way you can invest your Bitcoins and store them safely instead of using a traditional wallet or an exchange. Consider an IRA. Today's sponsor, iTrust Capital, is one such IRA that offers 35 crypto assets and the lowest trading fees in the crypto IRA space at 1% only. And being an IRA, it also offers unique tax benefits. If you'd like to get started and learn more, click on itrust.capital/David in the link down below or scan the QR code up here. If you're over 18 and you want to open a new account with cash or roll over an existing account, you can do so using my referral link. And if you use that referral link, you'll get $100 in signing bonuses. How much of this lull is due to perhaps people just waiting to see U.S. election results? Presumably Harris or Trump, doesn't matter who wins, they would have differing views on foreign policy, which may lead to differing outcomes when it comes to geopolitical risk premiums. Would they not?
Yeah, I think we have a bit of a counterintuitive take on what happens to commodities in the event of Harris versus Trump, becoming president. The thing about the commodity sector that you have to understand is that left to their own devices, these companies will drill themselves into bankruptcy. And in fact, historically, they make most of their money during Democratic administrations because Democratic administrations tend to be anti-fossil fuel development, which is a sort of artificial dampener of supply, which leads to higher price, which leads to profits for the energy companies. And in fact, even though the executives at the sort of marginal oil company would probably lean conservative, they ought to be voting Democrat for their own wallets. And if Trump becomes president, I think we will see a swifter resolution to the war in Ukraine, which is bearish for commodities. And also he would drill, baby, drill. And drill, baby, drill is very bearish for commodity prices. And I think at least some of the recent weakness that we're seeing in the oil price is tied to that Trump seems to, at least in the past 10 days, have sort of rebounded from the Kamala burst after the candidate switch that the Democrats did. And, like people like Nate Silver and so on are putting relatively stronger odds that former President Trump returns to office. And in that case, I think that would be pretty bearish for the commodity sector because they don't have a history of demonstrating the discipline needed to avoid incinerating shareholder capital in the name of growth. And they make all their money on price, not volume.
Yeah, and to your point about drilling in the U.S. under the Democrats in the last 3.5, 4 years, oil production in the U.S. continued to go up. It didn't fall. So I don't think, is it fair
right.
to, right? Yeah.
So now imagine Trump comes in and removes all of the legal barriers and permitting barriers. And right now, the U.S. is drilling, as you mentioned correctly. The U.S. is the world's energy gigapower, and it's doing this with a hand and a half tied behind its back. If it were left to its own devices, it would be drilling even more. The constraining factor to growth of energy production in the U.S. is regulatory, not technological, and not financial.
Wait a minute. Can we make the assumption that a Trump victory could be bearish for oil, given that, well, like you said, if the shackles come off and we get a lot more supply, wouldn't that just flood the system?
Yeah, absolutely. That's our position for sure. And especially when you consider that the history in this industry is a complete inability to exercise any discipline whatsoever. As we wrote in a piece recently, when the Saudis engaged in a price war against the shale producers in the U.S., they just drilled right through it. I mean, they drilled as much or more at $80 a barrel as they did at $30 a barrel. And ultimately, the Saudis had to cry no mas.
Okay, well, perhaps a Trump victory may not be great for oil investors, but if that narrative were to hold, but perhaps it's good for inflation. To what extent will lower energy prices contribute to lower inflation, Doomberg?
I think a Trump victory means lower energy prices, lower inflation, and higher growth. And a Harris victory means higher inflation, higher energy prices, and less growth, more government, and more inefficiencies that come with that. I think that's sort of the conventional view that I think stands up pretty well to inspection. And so in Trump's eyes, low energy prices are good because he intuitively knows that energy is a critical input into the overall economy. And as a business person, he understands that cheap inputs lead to the opportunity to have higher value manufacturing added on top of those inputs. And the U.S. has been hollowed out from a manufacturing perspective, but that needs to change. Obviously, geopolitical tensions with China are driving ever more reshoring, onshoring, friendshoring, and cheap energy is a key input into that. And in fact, one of the reasons why we made a call earlier this year that we didn't think the U.S. would fall into a recession ahead of the election is because of just how cheap natural gas is and just how important it is to so many industries. And so Trump would put the pedal down on energy, which is bearish for energy equities. And, you know, even though people who might be inclined to invest in energy equities might be conservative, Trump's victory would be bad for your portfolio.
Is there theoretically a maximum number of barrels that the U.S. could produce with even with fracking? I mean, presumably, there is still peak oil in theory, is there not?
We don't think so,
Okay.
especially as the line between oil and gas continues to blur,
Okay.
as you see either the molecular conversion of gas into oil-like products or the changing of engines to do the work that diesel would do on the back of natural gas. We have an infinite supply of natural gas for the next 50 years. I mean, obviously nothing is infinite. The Earth is a closed system. We get all of
Sure.
that. But for modeling purposes on a time horizon that anybody here cares about, the gating function to production in the US is regulatory, not geological, not even financial. But we did a piece on Western Canadian resources. There's so much natural gas in British Columbia and Alberta. It's crazy. Just imagine, like, California has basically the same resource base that Texas does. It's political that California is a flaccid energy vassal and Texas is a global energy superpower. Those choices can be overturned. Um, if we temporarily restrict supply because of political reasons, the resulting price shocks will quickly sweep away from power those politicians who were in favor of those restrictions. And so we have an enormous amount of oil in the Western Hemisphere. Just let's go up and down the Western Hemisphere just to give your listeners some perspective about what's possible if we could get our political act together. You have Canada, one of the largest resource bases in the world. We have the U.S., which is the leader in both oil and natural gas by wide margins. You have Mexico, which is a fraction of its former self for purely political and business mismanagement reasons. But if you could get Mexico up to par, you could radically increase their supply. You have Venezuela, which has the largest hydrocarbon deposits in the world, pumping gas at less than a fifth of what it used to, and could probably 10x its supply with the right leadership. Next door to Venezuela, you have Guyana, where all of the majors of the oil industry are aggregating around one of the most prolific growth engines in supply that we'll see in the next 10 years. It's pretty tempting to imagine regime change next door and combining Guyana and Venezuela and getting a stranglehold on massive supply. You have Argentina with Malay. They have huge shale deposits that are being developed. And then you have Brazil, which is an emerging power in its own right, part of the BRICS nations, of course. But if the U.S. just concentrated on the sort of Monroe Doctrine in the Western Hemisphere, we'd have very little need or use for the Middle East.
Okay, so then in your opinion, what are the biggest constraints to realizing full supply potential in the West?
Almost exclusively politics. We have in the U.S. Sustained lawfare against the development of any resources, like the LNG environmental justice decision I referenced earlier. You have political upheaval, of course. Latin America is unfortunately the history of Latin America is filled with regime change, CIA inspired or not. It's not, political stability is not a hallmark of the Western Hemisphere, unfortunately. But none of these things are intractable. There's just put it this way, put your original question. There is no geological constraints to producing all of the oil and gas we could ever need. And by the way, I mean, the price of oil in ounces of gold is near an all-time low. If you don't count the COVID upheaval, the price of oil in real terms, which is how we measure it in ounces of gold, is lower than it was when Reagan was president. I mean, these oil and gas companies are deflationary machines. I mean, they are
Right.
technological powerhouses. Their technology is indistinguishable from magic. Chevron's 20,000 psi deep water drilling breakthrough this year will spread to all the other majors, and suddenly we'll have an entirely new resource base that was considered uneconomic or off limits. We always find a way. The human endeavor is a constant, unrelenting struggle against the forces of entropy, and we find a way to produce enough primary energy beat back those forces of entropy and ensure a higher standard of living for all on the planet. And that force will continue.
By the way, people complain about high gas prices at the pump, and they should. But yeah, I mean, you laugh, but this is the point I'm trying to make. 5 years ago, 6 years ago, in 2018, I'm looking at the WTI price. It's the exact same as it was today.
Yeah,
So,
and I tell you what, the price of a Big Mac ain't the same as it was back then.
right, inflation adjusted. I think you can make the argument that over the past 5 years, the oil price has come down, right?
Oh,
Do you
measurably,
do you see
measurably.
the real inflation adjusted price of oil continuing to go down in the next 5 years?
Absolutely, yeah. And in fact, Bloomberg provides a handy service where they tell you what the inflation-adjusted price of oil is
Mhm.
using, I think, 1983 dollars. It's $22 right now, and it's truly. If you look at the inflation-adjusted price of oil from Bloomberg, the price today is cheaper than it was in the early 80s. And by the way, most people believe that the government inflation data, which is the foundation of this adjustment, is understating inflation. And so it's actually far cheaper than $22 a barrel. And I happen to believe that, which is why we look at the ounces of gold required to buy a barrel of oil. It's a tiny fraction of an ounce that buys you a barrel. These fossil fuel companies have done so much for the elevation of global standards of living for so little credit. It's unbelievable.
I want to talk about one of your pieces in your Substack called "How OPEC Ends," but I want to get to that later. So, it's a good piece. Stay tuned for that if you're watching right now. But first, a question on the cartels. What are the cartels going to do to keep prices elevated? Like you said, there's no geological constraints, so they have to do something. Otherwise, the prices would collapse.
Look, it must be credibly said that OPEC is the most successful and impactful cartel of all time.
Hmm.
So, full credit to the OPEC members for having managed the oil market for 65 years now. But as we wrote in the piece that you mentioned, how OPEC ends, it is our view that their time at the helm of global oil prices is soon over. The more they hold back production, the higher the oil price is than it would otherwise be. The more motivated other producers and technology developers are to invest to gain share, which they're doing, and the temptation to cheat grows. And so, in fact, OPEC is down to just 12 member countries from 15 in 2019. We're seeing defections from the organization as individual countries decide that the incremental gain of drilling on their own terms is worth it for them. One key thing to keep an eye on, we think, is the fate of Venezuela. Look, depending on your bias, the president of Venezuela either just blatantly stole an election or narrowly stared down a US driven coup attempt. And maybe it's both. But in our view, it's only a matter of time before Venezuela comes up back under the US sphere of influence. And that would be a crippling blow to OPEC, not just because they'd be losing Venezuela as a member, but the growth that we could extract out of Venezuela compared to what it's doing today would be remarkable. Venezuela produces 700,000 barrels of oil today. At its peak, it was over 4 million a day. Now imagine what it could do with the best of Western technology.
Okay. I want to come back to that, so we're not going to spoil too much for the audience right now. But going back to the U.S. markets, so yes, suppose inflation-adjusted oil prices continue to trend lower in the future. Well, the government needs to collect taxes, revenues from the oil price, from the gas pumps. So, presumably they would find other ways to collect lost or I guess, unearned tax revenues from the gas pump. People were talking about in California the prospect of charging per mile driven. Have you looked into any such government initiatives to recuperate lost revenue from gas prices?
We have, but in the US, you have to remember, among the energy superpowers, the US is pretty unique in the sense that it also has a very robust downstream value add manufacturing sector, as well as the world's largest and most prolific technology center. Like we are the center for data, AI, high technology. And so the tax base of the U.S. is not as heavily dependent on primary energy production as others like Saudi Arabia, Iran, and what we would call petrostates. The U.S. is, of course, a huge petrostate, but it has this downstream value add. So just let me give you one example. Natural gas being so cheap, like at $2 a million BTU, it's $12 a barrel oil. We have a vibrant chemical industry, fertilizer industry, all of the cogeneration facilities in the country that produce both electricity and steam for industrial purposes are getting an amazing free ride, basically, compared to their global competitors. This is a huge advantage for the US. And so if oil prices continue to grind lower on an inflation adjusted basis, that is actually net accretive to tax collections because of all of the other beneficiaries, the downstream value added steps that aren't present in most other petrostates.
Okay, I want to talk a little bit about the labor market now. This came in from Bloomberg. I know journalists like to ascribe reasons for, oil price movements, but anyway, here comes an article from Bloomberg last week. Oil tumbled, heading for the biggest weekly drop in 11 months as a weak U.S. job report added to concerns about tepid demands in the world's largest consumer of crude. Talking about the U.S. here. So WTI fell about 2.4%. The trade below 68 dollars a barrel, on pace for its biggest weekly loss since 2023. U.S. jobs data released Friday increased speculation that the Fed may make a supersized interest rate cut. Have you noticed, this is my question, have you noticed any direct or plausible relationship between strength in the labor market in the US and energy prices?
Yeah, I mean, that's kind of gibberish if we're being honest. I
Okay.
mean, I think what's going on is that we have ample cheap supply and switching towards natural gas in China. And these markets are actually globally traded. And what happens in the US is of minor significance to the marginal supply demand balance worldwide. I mean, oil tankers are floating all over the oceans. If there's lack of demand in one place, it can easily be made up for somewhere else. The oil markets are really well supplied. OPEC is being forced to keep incremental capacity offline. China is switching away from diesel and oil and gasoline. Their EV market is big. That hurts gasoline demand, and they're switching to natural gas on the diesel side. That's why you see crack spreads on their knees. We are in a long market now. When will that inflect and change? Who knows? But right now, the U.S. jobs report, which, by the way, nobody believes, is not a driving force for where the primary energy futures markets are trading.
I understand. Well, we have to talk about the Federal Reserve. It's expected that in a week and a half, not even, that the Fed will cut rates for the first time in a couple of years. Would that have any impact on energy demand?
Not directly, but historically, recessions happen after the Fed cuts rates for the first time, right? And
Sure.
so that's generally not a bullish indicator in the medium term. And I think it's also very political. We're heading into an election, and it's very
Sure.
clear that Yellen and Powell would prefer to see a Democratic victor than Trump. And so they're going to pull out all the stops ahead of the election. There will be some stealth stimmies going out, and there will also be some nectar for the stock market gods. And rising stock prices makes everybody feel rich, and the richer you feel, the more likely you are to vote for the incumbents. And so
Mhm.
this is quite predictable. I don't think a rate cut is necessarily justified based on the macroeconomic data that we see, but they're going to probably cut rates for political reasons. And but I think the markets also kind of properly sniff that out. But I don't think, like, if they're cutting rates for real reasons, that would be pretty bearish for oil demand because it would signal that we're heading into a recession.
Interesting. You said it's not justified based on the macroeconomic data that you're seeing. What do you mean by that? Are we not in a slowdown enough for them to at least justifiably cut rates?
Again, it becomes difficult if nobody trusts the data. So if you,
Okay.
if you point to recent revisions to GDP data, it's not like
Yeah,
not like it's
revised up.
clear. Yeah, it's not like it's clear that we're heading into a recession. We have
Mhm.
dirt cheap energy. We have plentiful supply of energy. We have an AI revolution ongoing. That demand for power to fuel data centers is probably inflationary. I think we're going to see electricity prices around the country begin to edge up as grid operators um, struggle to feel the newfound inbound demand that AI is driving. So there's plenty of inflationary type activities going on. Um, and so I don't know that the Fed should be cutting interest rates right now. But again, these are decisions that are well beyond our pay grade.
Yeah.
If you would have asked me in January when will the Fed cut rates, I would have predicted September, October,
Yeah.
based solely on the electoral calendar. And here we are, getting all of the pumps primed for a big interest rate cut in the face of otherwise relatively good data. Unless you just don't believe the numbers. But I mean, we've had people calling for a recession for 15 months, and it just hasn't materialized. Yeah. Again, all bets are off if you don't believe any of the numbers. But then it's hard to be an analyst of any kind if you don't have some semblance of a basis of analysis.
Very good. Well, let's shift now to geopolitics. We talk a lot about how geopolitical events impact the energy market, but I think this story may highlight how oil in particular is being used as a tool to impact global geopolitical dynamics. So other way around. I'll let you interpret this. So Russia built covert trade channels with India, leaks reveal. This is from the Financial Times. Russia has been secretly acquiring sensitive goods in India and explored building facilities in the country to secure components for its war effort, according to Russian state correspondents seen by the Financial Times. Importantly, here it says the plan, revealed in letters to a shadowy trade promotion body with strong links to the Russian security services, aimed to use significant reserves of rupees amassed by Russian banks from booming oil sales to India. It saw India as an alternative market to source crucial goods previously supplied from unfriendly countries. So, and the rest of the article goes on to elaborate on this. From my understanding of what's going on, and I'll let you elaborate on this, it looks like Russia has been selling oil to India and now using India as a base to, I guess, prop up its war efforts against Ukraine. Have you been following the story? Can you elaborate more on what's going on?
Sure, we have certainly been following the story, and it's the least surprising thing I've read this year. Like, of
Okay.
course, of course, India was going to take a discount on Russian crude, and also then on the back end sell them some of their own technology for a profit. This is international trade. I mean, um, oil for weapons is what the Saudis have been doing with the U.S. for decades. This is sort of the natural state of affairs. Oil-rich countries have an elevated need for defense, and they trade their oil and recycle the profits from their oil trade into the purchase of weapons, which makes everybody happy. The military industrial complex gets paid, the oil companies get paid, the dictators who run these petrostates are secure in their position. In this specific case, of course, India and China were going to keep trading with Russia, which is something we have been saying from the onset of the breakout of hostilities in Ukraine. Unless and until the U.S. is willing to sanction everybody on Earth, somebody is going to buy Russia's oil and give them weapons in return.
Yeah.
That's just like thermodynamics.
Well, here's my question. Importantly, they were trading oil with Indian rupees. Now, the de-dollarization camp would cite this as an example of de-dollarization happening around the world. But to what extent is this just normal trade? I mean, presumably, cross-border trade outside of the U.S. isn't always done with the dollar, right? So, is this a
Yeah,
sign of more de-dollarization, or is this just normal?
I think it's a sign of the fact that transacting in dollars means you kind of have to fess up to what you're doing to the U.S. Treasury. And neither of these parties wanted to do that. And so they're trading outside of the US dollar system because the US is using the dollar and the know your customer reporting requirements and so on of all of the banks in between such trade as a weapon. And they're treating the dollar as a weapon. And that works for a while. And the more times you use that weapon, the less effective it becomes, as this forces the behavior that is described in the Financial Times article that you just read from, because they're not going to stop trading. Like the dumbest thing of the war that we've seen so far is this belief that somehow marine shipping insurance would be enough to put a cap on the price of Russian crude, as though Lloyd's of London is some impenetrable moat for the G7 to dictate price terms between Russia and
Mhm.
China or Russia and India. It's just crazy, crazy talk. Like, I don't know how our leaders can come to such conclusions. Of course, if Russia offered plentiful supply of cheap oil to India, India would do whatever it took to get that oil. And one of the things it took to get that oil is to do it in currencies other than the US dollar and to insulate the banks that are facilitating this trade from sanctions by the U.S.
Do you think there's going to be a permanent bifurcation of oil markets? In the East, we have a trading bloc, Russia and India, or other people trading with Russia, and in the West, a separate bloc with different prices.
I'm not sure that prices will differ because intramarket penetration drives arbitrage, which drives profit seeking, and it doesn't take much in the way of spillover between the two markets
Sure.
for prices to converge. That being said, I think on a volume basis, we're already seeing that. Yeah, absolutely. In a
Well,
way, go ahead. Yep.
that begs an interesting question. If Russia were to sell India crude at a discount, what does that mean for arbitrage traders?
There's a difference between the quoted price that we see on our screens and the transactional price that a oil producing company and a refining company will transact at. And so oftentimes the sort of benchmark trading, which has a lot more financial participants than industrial participants, is an input into such prices based on formulas. But the real effect of direct sales from, say, Russia to India or Russia to China, or if our Siberia 2 pipeline for natural gas gets built between Russia and China, is that you're taking sort of the volume off the traded market and into the industrial market. And so, but in reality, companies trade products back and forth at discounts of benchmarks all the time. And in fact, a lot of the contracts between suppliers and consumers are built on a discount to WTI, for example, or pick your favorite. So that I don't think that would have a big effect on arbitrage opportunities.
Interesting. Okay. Overall, then, do you see strengthening ties between Russia and India?
I think until the war is over, it is in Russia's interest to have strong ties with India, and it is in India's interest to have strong ties with Russia. If and when the war ends and how that war ends may change things, but it also should be said that Russia and India have had a multi-decade long close relationship. India has procured significant weaponry from Russia. And so it's not surprising to us. And by the way, like India broke the Russian sanctions. Like, let's be clear, India
Yep.
broke the sanctions on Russia. And of
Yep.
course, when we had a diesel crisis in the Northeast, where did we procure incremental supply of diesel? We bought it from India, which was refining Russian crude. And so we're not exactly a clean shirt in the closet here either. When push comes to shove, everybody wants a deal on energy. And this is a fundamental axiom of economic development. And so somebody somewhere is going to buy cheap Russian crude. It was always dumb to try to sanction their volume. The proper way to have hurt Putin early in the war was to have overproduced on our side, driven the price down, and killed his profits. We didn't do that. We increased the frictions in the market, which led to incrementally higher oil prices, which allowed Putin to more than make it up on price.
What is the recourse for breaking Russian sanctions? If India or anybody else trades with Russia, is prohibited by sanctions imposed by the U.S., what does the U.S. do with the trading country?
Well, again, it comes down to, are you willing to sanction India? And what does that
Yeah.
mean? What about all of the generic medicines that come via India to the US? If we're going to sanction China, what does that mean about all of the rare earth elements and other critical minerals that China has a stranglehold on? Like, it's not like people don't punch back,
Hmm.
right? Like, one of the reasons you don't get into wars, you might lose it. It's like we walk around as though everybody must submit to the US dollar, and no matter how many times we pull the trigger on that weapon, it's never going to lose its efficacy. Of course, people are going to respond and they're going to adapt. And BRICS is growing. We are going to see a bifurcation between the global south and the developed world. And this is why we believe gold has been on such a tear, because the rest of the world would like a neutral reserve asset. US treasuries had played that role for decades, but they're no longer neutral. Nobody would argue after the freezing and potential seizure of the Russian reserves that US treasuries are neutral, or that European government debt is neutral. No, they're political. And we have crossed that chasm. We have decided that if a country steps out of the line of where US foreign policy and geopolitical interests lie, we're not afraid to use the dollar as a weapon. So that's fine. We've done that. We continue to do that. How far are you willing to do that is not a question I see debated. But are we really going to sanction China? I mean, are we really going to sanction India to the full extent to bring them in line? And what are the consequences of doing that? What are the second order consequences and the third order consequences? We thought this through. So we'll see. Running record deficits, national debt going up, what is it, $1 trillion every 90 days. Most of that debt is funded in short-term paper, which is eerily familiar to how emerging market debt crises get started. Who's going to be the incremental buyer for this stuff?
Yeah.
Is an open question, and we'll see.
Final piece of geopolitical news I want to talk about, and then I want to get back to your Substack article. So here is once more from the EFT. This is in regards to Israel and the Hamas war. Netanyahu's defiance underscores challenges in securing Israel-Hamas deal. So basically, this came in 2 days ago, a day after Israel confirmed that Hamas had killed 6 hostages in Gaza. The Israeli spy chief flew to Doha to hold talks on the floundering U.S.-led diplomatic push to secure the release of the remaining captives and end the war in the Strip. Importantly, later on Monday, Netanyahu held a lengthy press conference in which he vowed not to surrender by agreeing to a deal, dismissed the demands of the protesters, and doubled down on the need to keep troops on the Philadelphia corridor seemingly forever. So do you see this as just status quo or an escalation?
Boy, I'd say the situation in Israel slash Palestine, Gaza, is a very dangerous one. It's one that is filled with very deep emotions, one where your pre-existing biases dominate how you read news articles like that.
Mm-hmm.
I would say back to the U.S. election situation, the Democrats are in a bit of a pickle politically because swing states like Michigan and even Minnesota have a large inbound immigration from Arab states, and they're not happy. There was a sort of an underreported political storm at the DNC convention, for example, about the fact that sort of no Palestinian speaker was allowed to speak. They're trying to thread the needle of supporting Israel without paying the political price for such support. And there's an ongoing debate within the U.S., between the two sides. We see the protests on campus, and we see how those protests are portrayed in the news. I think the thing that gives me some comfort is that the markets aren't pricing contagion. Like the oil markets in particular, are not pricing significant risk of contagion outside of the direct conflict, to say with Iran. We had that assassination of the leader of Hamas in Iran during the presidential ceremonies. That could have easily led to a much broader war, one that's still on the table, but the markets aren't pricing it in. And so,
Right.
If the dispute remains contained within Israel and Gaza and the West Bank, I think for all of the emotions and understandable emotions involved in this situation, it's not really going to be all that important geopolitically outside of those areas. For those people, it's like extremely important, and I get that. But the biggest risk I think that the White House is trying to balance is supporting Israel without paying the political price for it, and it's unclear to me whether that'll work.
And if you take a look at the price of oil, just for illustrative purposes to the audience here, on October 7th, 2023, which is right. Let me just find that part here. It's about here. Right, there was a spike in oil temporarily, but that was short-lived. The geopolitical risk premium was not sustained. This drop following October 7th was mainly caused by what? The market realizing this was not going to spill over to other areas, Doomberg?
Yeah, I think we talked about it at the time. It
Yeah,
certainly didn't seem like the market was betting on a wider war. And to be
yeah,
frank, here we are, right?
right.
Almost a year later, and we haven't seen that wider war, despite provocations on both
Sure.
sides trying to trigger it. So it in the absence of sort of native expertise and or knowledge on the ground, I think the only thing people like you and I can do is look at the markets and see what they're predicting. Now, those markets could be wrong,
Yeah.
but oil is not telling us that there's going to be a war with Iran.
And it
Um,
doesn't seem like Israel and Iran want to, or at least it seems to me they don't want to get into a full-fledged war. There's been several back and forths this year with drones being sent from Iran, Israel sending, missiles in retaliation. Nothing catastrophic. They've more or less minimized casualties to civilians. It doesn't look like there's going to be an escalation, at least from an incentive point of view. It doesn't look like they're incentivized to do so. Am I correct?
Yeah, and it's also we have to be careful not to assume that both countries are monolithic. I think there's debate within both countries as to what the proper strategy should be. For example, I get the sense, again from afar, that there is some stress between the IDF and Netanyahu, and within Iran, of course, there are fractions of the country that are more pro-Western and fractions of the country that are more, let's say, conservative and or religious slash radical in their outlook. And so I don't think it does the complexity of the topic any justice to just lump them into the buckets of Israel and Iran, because all the political leaders involved are dealing with, they got their heads on a swivel. They have domestic opponents, they have domestic supporters, they have supporters who might pull their support if they're not tough enough, or they might, and in fact, like even Netanyahu, right? I understand that he's facing certain judicial proceedings and might want to be highly motivated to stay in office as long as possible. These are all complexities that are real to the players involved that make sort of the high level analysis a little bit tricky. But it does seem, I would say, to the credit of the administration so far, when these flare ups have happened, one gets the sense that the U.S., at least again before the election, does not view the wider outbreak of war in the Middle East as particularly constructive, and it has worked pretty hard to try to put the genie back in the bottle. Like you say, we have a bit of a theater missile exchange the last time this happened, and so that's look, we are anti-war, pro-peace, and anything that that maintains peace is positive. We understand that the situation in the Middle East is very tragic. It also does make the U.S. geopolitical situation and the ability to slow the BRICS development a little harder, because I think the global opinion outside of the sort of G7 is decidedly in favor of the Palestinians. That's just an agnostic analysis. And so it does make it challenging to convince people to not apply for BRICS membership and all of this other stuff. And so it's a challenge. It's a headache. For the U.S., it's life or death for the Israelis and for the Palestinians, and so it is. Nobody would look at what's happened in the Middle East in the past 50 years and say that's a wonderful thing.
To sum up market reaction to everything we discussed, do you think the oil markets are signaling a Trump win if it's going down? Is it predicting the election outcome? Is it predicting geopolitical outcomes? Or is this 13% drop from the beginning of the month really just normal volatility for oil, you think?
I think it's a bit of all of the above. I
Yeah.
think, markets aren't efficient, of course, but they're the best tool we have.
Yeah.
And I would say the combination of Chinese switching, fear of a recession, a potential Trump win, and the ability of the U.S. to keep the situation in the Middle East under some semblance of control are all conspiring to be relatively bearish for oil in the medium term. Again, we're one major geopolitical event away from all of that changing, as we've always just made sure to disclaim. But all things being equal, we see more headwinds than tailwinds, more headwinds than tailwinds. That's right.
Yes.
For the energy sector in the next 3 to 6 months. Once the election happens, that's a sort of a singularity event, and you sort of have to wait and see if there's a disputed election or if there is social unrest in the U.S. All bets are off, of course. But all things being equal, a lot of headwinds for the oil sector today.
Let's finish off on your piece, how OPEC ends. So I'll just read one paragraph from your Substack here. OPEC grossly underestimated both the willingness and the capacity of U.S. shale companies to incinerate shareholder capital in the name of growth, even as oil prices ground lower, eventually bottoming out in the upper 20s in January 2016, well below the estimated marginal cost of production for most shale upstarts. U.S. production climbed inexorably higher. The few companies that did file for bankruptcy either kept producing or sold assets to others that could, using the courts as a shield to recapitalize in the hopes of exploiting firmer prices in the future. Anyway, I'll let you elaborate more on your thesis. We talked a little bit about this. Is U.S. shale production basically going to be the end of OPEC? Is this how it ends?
It's a death by 1,000 cuts. It's going to be a combination of development of non-traditional resources, political changes that unleash traditional resources, U.S. shale, Canadian production, Guyana, and a few more defections. And I think what we're going to be left with is a rump of its former self. I think OPEC will continue to exist. And as we said in the piece, the leaders will use their regular meetings as a nice excuse to go to the Alps. Who doesn't like to go to the Alps? But by and large, the days where the mutterings of OPEC mattered as were the key determinant of oil prices, we think are very much numbered. That is a geopolitical sort of shockwave slash transition that we don't see enough people talking about in our view. And this is especially true as the line between natural gas and oil continues to blur because here, just Canada and the US produce twice as much natural gas as all of OPEC combined. And once we've taken control over the energy markets from the cartel, it's very hard to get that control back. And so we think it is, as we said in the piece, sort of perhaps a curious time to be making that call, given that we have this elevated risk of war in the Middle East and the war in Ukraine reaching its apex. But you have to think beyond what's going to happen in the next 2 to 3 years to see the long-term trend. And in our view, especially if Venezuela falls back into U.S. Sphere of influence, that would be a pretty devastating blow to what's left of OPEC. As we said, Qatar already left, and a few other countries have left in the past few years. The cartel's days are numbered in our view.
Do you think the U.S. will become the next OPEC?
Well, I think the U.S. is already sort of the most important energy producer in the world. I think the thing that I think people are missing is post-war in Ukraine, post-Putin Russia, there is a window where an enormous amount of commodities can be developed and brought to the market. Right now, it doesn't look that way. The arteries are cut with Europe. The political winds are blowing in a different direction. So in a world where countries start to behave in their own best interests in Europe, i.e. the European Union weakens, and perhaps in a post-Putin world where Russia is relatively strong, but led by a different and more palatable leader to Western business people, for example, you could see a world where, especially if the arteries are permanently redirected towards China and India additionally, in the end, there's an enormous amount of oil and gas in the world, and it's going to find its way to the market. And I think that spells serious trouble for OPEC.
Well, suppose OPEC disappears overnight. I'm not saying but just suppose it does. We have no more cartels. Let's suppose oil were not managed by any one organization or multiple organizations, a free-flowing market, if you will. What happens to the price, up or down?
Oh, down. Yeah, for sure. Absolutely. All frictions that are introduced into the market have the net effect, all things being equal, of elevating the price. You could look at the floor price of oil as being natural gas in the cheapest regions of the world, because that is the arbitrage from which the market will grind away at that disparity. That price is actually quite low. And if it got below the marginal cost of production for the players, there would be a shortage and prices would come back. And, oil markets are notoriously cyclical, and that's mostly driven by the fact that the investment cycles to develop oil and gas fields are out of sync with the business cycle. So you have these regions of time where, oil is long and in the doldrums and everyone is in despair. And then suddenly people stop producing. There comes a shortage and oil prices spike. The inelasticity of demand for energy is such that this is forever thus. And this is why we say that the global energy demand, as measured in exajoules, is a upwardly sloping, slightly sinusoidal wave. And you can bet that in 2050 we'll be using far more fossil fuel energy than we're using today. Oil will still be dirt cheap on an inflation-adjusted basis.
Excellent. Thank you very much, Doomberg. Tell us where we can find your work.
Everything at Doomberg.com. David, fantastic to be with you again. Always appreciate the invite. And I must commend you for the quantity and quality of the product that you're putting out. Really amazing stuff. I try to catch as many of your videos as possible. Truly one of my favorite channels on YouTube. Congrats to you and all of your success as well. But you can find everything we do at Doomberg.com.
Okay, Doomberg.com. We'll put that link down below. Thank you. Well, I appreciate your kind words, Doomberg. It's because of good guests like you that we have a good program. So thank you for coming back, and we'll have you back on again. So stay tuned for the next Doomberg appearance. If you have any questions for me or Doomberg, feel free to reach out. Email down below. See you next time. Cheers.